Okay, good morning everybody. My name's Ralph Hunt. I work for Face-to-Face Finance, and today's webinar is going to be about how the stock market reacted to the coronavirus pandemic and other crises. As you could tell, it took me quite a while to actually decide on the title, and I really don't think it's catchy enough, but there you are. So a little bit about me. I've been in the industry for quite a while now, getting on for around about 30 years. I started off with a company called Acuma that most of you will have never heard of, but that was part of American Express. I gave financial advice to their cardholders. I then went to work for Friends Provident, which was a mutual company in those days. And I worked both as an advisor and as a manager. And in 2003, I started working at Face-to-Face Finance as an independent financial consultant. So I think that's enough about me. A little bit about the company now. We're based in Cringleford. We're independent financial advisors, and we are what I would call truly independent. We're not part of a network. We can use whatever products we wish, and we're also directly regulated by the FCA. As you can see, we've been going for over 15 years. And we also have a sister company, which is called Face-to-Face Estate Planning, which we use for wills and trust work. And we've always said that at its best, financial advice is always better face-to-face. We do believe in sitting in people's houses or businesses and talking to them eye to eye, but it may be going forward a bit of Zoom to Zoom, you never know. So what makes us different? Well, a few things really. Here's a couple. First of all, we all wear slippers. There's reasons for that. One being it makes us more comfortable. It makes us more comfortable in the office, and research has shown that it actually gets more production out of people. We also have a director of happiness, and I always like to introduce him. His name is Eddie Teddy, and I'm sure a lot of you already know about him. He is an author, amongst many things, and his second book is coming out shortly. We've already had a couple of emails from JK saying, please don't launch it at the same time of one of hers. We don't want to take all her publicity. So here's the agenda that I'm going to go through. Basically, the current market situation, some typical mistakes that investors make, investment fund options, and I'll give you a chance to ask me some questions at the end. So what is that? Well, that is a picture of a black swan, and black swans apparently don't exist. So what is a black swan event? Well, it's an unpredictable event that nobody knows is going to happen, that has severe consequences. Now, there are people that says that we've got a double black swan at the moment. So obviously the first black swan is the coronavirus. With any other disaster that we've had in the stock markets previously, or in the markets in a whole, it's normally been man-made. Something has gone wrong. Going back to 2008, it was because some people in America decided that everyone should own their own home, so they gave mortgages to people who blatantly couldn't afford them. Those mortgage interest products were then wrapped up and sold on to other companies, and funny enough, when those people who could never afforded the mortgage in the first place couldn't afford the mortgage, they all unraveled. And when we looked back at that, we said, oh, that wasn't the best thing that we ever did. Whereas with this, at the moment, did it come because some people in China particularly like eating bats? Did it come out of a laboratory? We don't know. We're not sure whether we'll ever know. But the bottom line is it has affected the whole world. The second black swan event is actually the oil prices. I had a little notice, and it's typical. We can't go out and oil's really cheap, fuel's really cheap. It's like giving a hairbrush to a bald man. Not much point of much point of that. But really, the oil price is linked directly to the coronavirus. So let's look at the market, and the one I'm looking at is actually the Footsie 100. The only reason I've chosen this is because most people have heard of the Footsie 100, basically the top 100 companies in the UK. So what happened? Well, on the 1st of January, the Footsie stood at 7,600. And as coronavirus hit on the 11th of March, it was declared a pandemic. And as you can see, it was down 22%. But it fell further as we declared lockdown, and it fell another 17%, and actually giving a total of just shy of 34% downturn. So to give you an idea how that felt for our own clients, if the markets were down about 33%, our clients would have been down around about 18%. So that's a 16% difference, but a loss is still a loss, and nobody likes that. Well, when I say nobody likes a loss, actually the newspapers like a loss, and the internet likes a loss, because disaster brings people in to look. So oil prices dipped below zero. That was on futures, because nobody's using oil, and it doesn't matter how much you produce. If no one's using it, eventually you run out of storage. It shows that nobody knew about this, because the Russians and the Saudis were actually in an oil war before this coronavirus hit. And the Footsie 100, as you can see, suffers the second worst quarter on record. Fabulous, fabulous stuff from the news. So where does this all sit? Well, if we look at the S&P 500, so that's the top 500 companies in America, and this goes back to the last century, from the 1900s, pretty much up and past 2008. If you actually got someone to describe this, they would basically say, well, it's a wiggly line, but it does tend to go up. And that's pretty much what happens with the stock market. Why do the stock markets go up? Well, I'll explain that in a minute or two. But that's really as it is. And as you can see, the global financial crisis of 2008, that had a downturn in the market. But if you look at it as a whole, that still wasn't a massive fall. And to date, the coronavirus has not taken the markets down as 2008. So what do investors do? Well, there's two things that they should do. One is not panic. The second one is really not do anything, or even put money into the market, because obviously if the market is low, it's a good time to buy. But what you don't do is move your money to safety. The reason being is that if you move your money safely, you think, oh, well, that's good, but it's only good if the market keeps falling. And it's only good if the market comes back very, very gently. And as of yesterday, from the low point of the market on the 23rd, the market's come back 16%. So if you were sitting in cash now, you've guaranteed yourself a 16% loss. Your only hope almost is it goes back down again and you put it in. So from anxiety at the top, when the market starts to slide, you might as well go all the way down to discouragement instantly in your own head. Forget the fear and the despair and the panic and the capitulation. As a financial advisor, I'll do that all for you. So let's move on to what we say about the markets. It's timing the market, not timing the market, that works. What that means is if you'd have actually invested at the high points of the stock market, of all the stock markets, in every time, you would still have made profit. Being in the market is important. If there's an obvious low, like there is at the moment, you can always put more money in. So, talking about money, why is being in the market important? Well, I think this slide pretty much covers it. Imagine you're investing and it says £10,000, but it could be $10,000. If you invested January the 4th, 1999 to December the 31st, 2018, so that's 20 years, your 10,000 would have grown to virtually 30. And that's an annualized return of 5.62%. So that's all the disasters we've had. That includes 2008. You'd have made money. If you missed the 10 best days in the market, and to give you an idea what that means, Barclays shares yesterday went up almost 8%. They were the biggest winner in the market. So anyone with a Footsie 100 large cap share portfolio, that's basically big companies, would have had a good day yesterday. So you missed the best 10 days, you're down to 2.1%. You missed the best 60 days in 20 years. That's pretty much 2 months out of the market. Your 10,000 would have gone down to 2,144. You'd have had an average return of minus 7.41%. Not brilliant. So keep in the market. Now, when it comes to funds as an independent company, we can use pretty much anything. And overall, there are 3 types of funds. And the first one we're going to look at is a tracker fund. Now, these have come more to the fore over the last few years. And they've come more to the fore because they're cheap. This is a very, very cheap product. And we can use these for our clients. The problem with these is that they're designed to quite simply replicate an index, a group of funds. And when they go down, you get the full loss of the market. So quite simply, if you had a Footsie 100 tracker and you've invested before May 2018, you would have made a loss. And the reason why you'd have made a loss even after May 2018 is because the Footsie hit the height in 2018 and it's fallen since. Yes, the coronavirus has pushed it down at one time, and another 34%. It's still around about 20% off its height. Tracker funds, you have to be careful with them. Just because they're cheap doesn't mean that they're good. Passive funds. Well, passive funds are a little bit like tracker funds, except that they do have some human intervention. They're more expensive. Sorry, they're more expensive than a tracker. And the way that works is that the fund manager will look at this fund every 3 months. He will set the course for the fund. He will decide the asset allocation, and then off it goes. If he's got that wrong, he will not, or she will not, change it. So you are in a fund going in the wrong direction for the next 3 months, or whatever time period they normally use. But generally speaking, it's a quarterly cycle. So if they think Japan's going to be really good and they set off for that, a tsunami turns up, not so good for Japan, you know your money's going to go down. So now we come to the most expensive ones. Generally speaking, the ones that we use. And they are continually active managed. And they get a lot of bad press. They get bad press because people say, well, the fund managers, they don't always produce. And that's absolutely true, which is why as a company ourselves, we monitor these and we change the active fund managers. But when you look at our own funds, you'll see what active managed does. So these are the funds over a year. And as you can see, our risk, we have 7 risks. 1 is cash, 2 to 7. So we have put here 3 to 6 because they're the most commonly used. If you'd have had our investment, even between February and March, you'd have still been in profit with a risk 3 cautious. With a risk 4, which is the average, you'd have still been in profit. 5, you'd have been down 1.2%, and even 6, you'd have been down 2.89. That's our second highest risk. The Footsie had fallen by 23%, as had the other markets had also fallen. Even today, when, as I said, we're about 20% off, having gone down close to 34%, our clients will be anywhere between 1% short of the February highs of the year and 6% in the higher risk funds. So we're quite proud of that. So what do we think is going to happen in the future? Well, I'm now going to talk about a V and a U. Now, it depends on who you speak to, and as advisors, we're bombarded with information from fund managers, from people we don't even know but want us to place money with them. And they will say, well, it could be a V-shaped recovery or a U-shaped recovery. Now, let me explain what that means. A U-shaped recovery means that the markets go down and they stay down for a long time, maybe a year, maybe 2 years, and then they slowly recover. Now, if you're someone who's young and you're paying into an auto-enrollment scheme, or you're paying monthly in, that U-shaped recovery is really, really good for you. And I'll explain why in the following slide. However, the other school of thought is it could be a V-shaped recovery, i.e. the market went down very quickly and it recovers very quickly. And there are people who say that the markets could end up by the end of the year at a record high. And the reason why they think that is because we have record low interest rates, and also we have the stimulus by all the governments, their bond buying. When you buy bonds and you buy gilts and you buy debt, it will end up in the stock market and it will simply push the stock market up, because that's what happens when you're going after higher interest rates. If you bought a yield from the government at the moment and you gave them £100, they will give you 10p. That's a tenth of 1%. That's not very good. So you tend to look at other areas, which is why the stock market should go up. Whether it will go up U-shaped or V-shaped, we don't know. But basically, it will end up going back up. So anyone who's paying in on a monthly basis, this is good times for you. We call it pound cost averaging, and on this slide you can see that in June, in this example, the market fell. The red line is the price, and so in June you simply bought more units. That's why people paying in at the moment on a regular basis are doing very, very well. Our April this year was much busier than April previous, with people putting money into the market. So what do some of the people say? Well, this is one person, and he's Warren Buffett. He's the richest man on earth for buying and selling shares. He's never invented anything. He's never made anything. He just buys. And he tends to buy for the long term. And to give you an idea, he's the biggest shareholder in Apple in the world. He's the biggest shareholder in American Express, in Coca-Cola. He owns Duracell batteries completely. He owns railroads and various others. He runs a fund called Berkshire Hathaway that has about 500 odd billion, and he has enough cash that when the markets fell, he could buy McDonald's out and still have money left over. So quite a wealthy person. But what he says is be fearful when others are greedy, i.e. when the markets are high, be careful, because they could keep going higher or they could run out of steam, and be greedy only when others are fearful. So when other people are selling out of the market, and that was the whole market this time, fixed interest went down because they were worried about companies being able to pay for their debt. Property funds, the large property funds in the UK were closed, so you couldn't get any money out of that because they're not going to sell £1 billion property to pay you back your £1,000 that you've got invested in there. And obviously the shares fell as well. And at that time, you can guarantee that this man will be looking about to see what he can pick up. That's basically the presentation. If you've got any questions, please ask now. I've just been asked about what about a W-shaped recovery. Well, that could happen. We don't know if there is a second surge.
Ralph, what is the lowest amount you can kind of invest?
It depends on where you invest it, but some investments you can invest £5 or £10. Some of the online companies. We also have an online product that we can use, and but generally speaking, £50 or whatever. And with a modern product, you can start and stop it anyway. You can. It's not like the olden days where people tended to have savings plans, and it was something that they saved into every month, and they really worried about making the payment. With a modern product, you can just save, you can start and stop, you can up and down the amount.
Okay, brilliant. If anyone's got any, we've got some more questions here. So from Jack, should I be investing more into my ISA now?
Personally, I would say yes. It's what I'm doing myself. It goes without saying, as an advisor, I invest every month, but I've decided to cut down on the biscuits and use that money on putting it into the market.
Brilliant. From Jeremy, what are the key signs of a sustainable recovery actually occurring?
It depends on the information coming out, but you have to remember that unless the markets get caught short, that the market is always looking forward. So coronavirus aside, why has the market moved up 16% since the low? The answer is because it's seen that things are starting to open up. They're looking at air travel. I believe British Airways are starting to advertise flights, that sort of thing. Sustainable recovery, generally speaking, will come from government intervention, which we're getting a lot of through the stimulus. It depends on what your definition of a recovery is. My definition is stock market. Is it moving in the right direction? Other people may be a complete return to normality.
We've got a question from Catherine. What impact do you think the current situation will have on attitude to investment in housing?
That's quite a tricky one. At the moment, we have a housing shortage, and we still have that. The government want builders to start building. So, and in 2008, the house prices didn't really fall because people wouldn't sell their house. I personally don't think it will have, and I could be completely wrong. It's not an area of my expertise, but I don't think that will change very much, because it comes down to rental yields.
Brilliant. Okay. From Nigel, is your aggressive fund all equity, and are you using ETFs investment trusts?
The answer to that is yes and no. Our most aggressive, which is a risk 7, is all equity. The risk 6 that we showed you had a certain amount of fixed interest in, and no, we're not using EFTs.
Can you just clarify what EFTs are again? Sorry.
An EFT is an exchange traded product. It's basically a synthetic product that it's a bit like a tracker fund.
So we've got another question from Jack. So rather than paying off mortgage, invest in an ISA?
It depends on your attitude to risk. You have to look at it from a mathematical equation. If your interest rate is 1%, and you can have an average return on a reasonable investment of say 6%, then you're better using the investment. But it really is down to the individual. I personally still have a mortgage, and the reason why I still have a mortgage is because I prefer to use my money to invest, because I have a low interest rate. Now that doesn't mean that I can't pull my money back and pay off the mortgage if I wanted. That's a different thing. But it also depends on your age. So it's quite a difficult one to answer. But purely from mathematics against interest rates, then you should have an investment. But if I was coming up to retirement and I still had a mortgage, I'd want to pay that mortgage off.
Brilliant. We've got a question from Nigel. The market has moved up, and do you think this has accounted for the very likely chance of a higher unemployment rate and redundancy?
Well, I think there's going to be some blood on the streets. The markets actually like redundancies. You have to remember that the markets aren't a particularly nice thing. When people are making other people redundant, when companies are cutting wages, basically they're cutting overheads. So that makes the company more profitable. Now, if you have to get rid of everyone to keep the company going, then I would be worried about the actual companies themselves. One of the winners of the 2008 downturn was a fund manager called Michael Burry, and he worked out that was going to happen. A few people did, but he was quite famous for doing it. And one of the things that he is dead against are tracker funds. And the reason why he's dead against tracker funds is he says that they hold up a lot of poor companies through people investing in their shares through these trackers. And he said there's companies out there that are famous companies that should now be bankrupt because they're not good enough to run as a company themselves. And I think as each day go by, you can see which companies have got the deep pockets and which haven't.
There was a film based on that. Was it called Big Short?
Called The Big Short, yeah. Shortening the market means that you're betting against it.
Yeah. Brilliant. Okay. From Nigel, what is your view about how much cash to hold, 6 months to 3 years, to ride out the dip? Would you hold cash as cash or in short-term government bonds?
I personally hold cash as cash. And again, it's down to the individual and what they think is right. You know, I would normally look to around about 6 months. Whenever we're dealing with a client, we like them to have a good emergency fund. I have got one client that's got 5 years in cash, but only one. But they are a very, very wealthy person who's investing a lot of their other money at the moment into the market. So from a cash point of view, really you should work out what your outgoings are, and you should build up an emergency fund. before you do any investing.
Brilliant. I think that's all the questions we've got. So that's great. I'll just give it a few more minutes in case anyone's got any kind of follow-up questions as well. Please just use the questions and answers, the Q&A functionality on screen. And what's the best way to get in touch with yourself, Ralph?
You can do it via the website, or you can phone the office. Our details are there. Hopefully everyone can see them. And you can also email us at info@f2f-finance.co.uk.
Yeah. What I'll also do is I'll email everyone the recorded webinar as well. And is it okay to copy in your contact details, Ralph? So if anyone's got any follow-up questions, they can get in touch?
Yes, that's not a problem.
Brilliant. Oh, and I've just had Jack asking, will you provide slides for reference? So Ralph, if you're able to email me over your slides, I can include that as well.
Obviously, I'm going to say, of course I will, but as we all know my technical abilities, I'm sure a grown-up in the office will do that for me.
That's absolutely fine. That's brilliant. So thank you so much for today's really informative workshop. I've definitely learned a lot about the stock market. But yeah, thank you so much for delivering today's workshop, and for everyone for listening. So yeah, have a great day.
Thank you.
You.
Thanks for everyone. Thanks for the questions. Bye-bye.
Bye.